There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Just gone 4 a.m. here in Sydney. Welcome to the COB. I'm Juliette Sarli. On a day when we have really seen a lot of the heavyweights that are paying out their dividends or trading without rights to their dividends weigh on the overall market. Let's have a look at where we have finished. We're down around 1/3%. The market did attempt a little bit of a better session in the mid-day. We saw a little bit of optimism, particularly, or a lot I should say, from the gold miners, with gold hitting that fresh record high. But we have finished slightly lower, off by about 1/3%. Banks, though, looking good as well today. But it all was, as I mentioned, about some of these big heavyweights trading ex-div. So we had the dividend drag, also talking about gold hitting that golden record, and Mark Jokum from Global X ETF saying he thinks gold will hit 4K by next year. Also navigating volatility as we got some of those GDP partials out today ahead of the official economic print, and Janice Henderson saying the Australian economy is still navigating global volatility. Their fixed interest strategist Emma Lawson saying markets though remain relatively stable despite the heightened global uncertainty. And of course we've got these structural housing shortages continuing to pressure affordability, and I'll talk about the housing issues as well with our COB guest Martin Crabb from Shaw and Partners. Let's have a look though at some of the sectors, and particularly with the gold breaking through 3,500 for the first time. You are seeing some very good moves there. I think we need to update that board because poor old De Grey is not on there anymore, but Newmont had a good session, up by about 0.8%. Looking at the consumer discretionary stocks as well, Wesfarmers among those trading ex-div today, so that was down 3% today. Consumer staples also coming under pressure as we saw the likes of Woolies also trade ex-div, down by almost 3%. Endeavour Group off by 2.4%. When it comes to the corporate news, Collins Foods had a great day, up almost 8%. Now, it seems like we're eating more KFC than we were this time last year. Sales up almost 7% in total for the first 18 weeks of the 2026 financial year. And Collins Foods says that was driven by KFC sales, which I think were up something like 5% in Australia and more than 8% in Germany. Polynovo also in focus. At one point it was up by 20% as it came out of that trading hold, also telling investors it's well positioned to gain from proposed changes to US Medicare reimbursement for outpatient wound care. Platinum Asset Management, though, weaker. It's seeing a large client set to pull $580 million from its remit, and that's just weeks before it's due to merge with L1 Cap. NRW Holdings surging to an over 13-year high on the acquisition of Fredon Industries, and Brambles there just slightly higher. It did defend, though, its share price surge after its full year result. Let's welcome to the COB Martin Crabb from Shaw and Partners. And am I right? Is it the dividend drag? Are we starting to see the September effect? What's happening?
Yeah, the seasonals for September are horrible, not just in Australia but around the world. Look, and a big part of that is the number of stocks going ex-dividend. So I did a calculation today. There was $3 billion of dividends, cash dividends paid, and another $1 billion of franking credits. So that's a big pill for the market to swallow, right? So as you noted, Wesfarmers and Woolies, two very well-owned stocks, and both falling by their dividends and a little bit more. And you know, you mentioned the September effect. It does seem to be like a global phenomenon that if you sell the market at the end of August and buy it at the end of September, you tend to do well. So that's just weighing on people. Obviously, at the end of reporting season, which previous guest George Babura said was a bit mixed, and not a lot of signal from that. And then also we had a holiday, so in America, when America's on holiday, we all just go, well, we'll just literally mentally take the day off and worry about it all tomorrow. So a bit of a mixed bag today.
Yeah, and you were talking about with those dividends that are about to be paid or have been paid with the likes of Woolworths and Wesfarmers. This dividend tsunami that's coming our way too.
It is, yeah. Look, it's not as big as in previous years. I think the iron ore miners were pumping out massive fully franked dividends a while ago. But this is today. So today was like $3 billion plus $1 billion franking credits from those Northern Star, Woolies, Wesfarmers and Santos. The big jump up there is obviously BHP. That's like a $6 billion dividend. But this month, and this is only in the next couple of weeks, we get up to $18 billion of cash dividends and another $6 billion in franking credits. No, those franking credits don't go into your bank account. You have to claim them back from the ATO when you do your tax return. But nevertheless, the market does value those. So you got $24 billion just in the next couple of weeks being paid. And this is a typical seasonal pattern. You have another one when the banks all go ex, but they're typically, with the exception of CBA, March balances, or September balances. So they tend to go ex in sort of October, November. But you do get all the industrial companies with June balances paying now.
What about with gold? Are people believing the rally, 3,500?
Yeah, look, it's starting to feel a bit squeezy, isn't it? So the price of gold itself has been on a tear, I think, in Aussie dollars. There's the chart in Aussie dollars, well over $5,000, which, you know, that's a 25-year chart there. So it's been kind of a one-way bet. But we did get a pretty strong rally in gold prices back at the start of 2011, 2012, and earnings for companies back then shot really high and then came off rapidly. So even though the gold price did drift down from, you can see it on there, a couple of $1,000s to $1,500, during that period, gold stocks sold off quite a lot. So everyone got very, very excited when it was having that big run like they are now. But there's a little bit of maybe the earnings have rolled over. So I don't know if you've got the chart on the earnings, but it does seem to be that the forward 12-month earnings outlook for gold stocks has just come off a bit. Now, it's clearly not due to the price. The price, as that chart shows, is very strong. It's more on the cost side, Juliet. So every miner that came out with their quarterly production results and their financial results just talked about how much costs have gone up, like 20 or 30% in some cases. So the gold price itself is up 30% this year, but sort of if you roll that cost structure going forward, we might actually see peak gold mining earnings. Now, I don't think the share prices are reflecting the earnings they're making at the moment, let alone next year. But you can just see that the earnings per share growth for the next 2 years has come from sort of plus 60% a year ago to plus 33. Now, that's still really strong growth. Like if you're a company and you're growing your earnings at 33% over 2 years, that's still pretty good. The PE ratio of the gold mining sector has not kept up with that, but we're just starting to see signs that people's cost estimates, their all-in sustaining costs as they call them, for the gold miners are starting to go up. So we still think there's a little bit of a gap. There's a bit of a gap to close, but we may be getting towards the end of the upgrade cycle for the gold sector.
How did you view reporting season as a whole? Because there were some huge swings from big cap companies.
Yeah, I think I saw a chart of share price volatility, daily share price volatility during the past 6 reporting seasons, so February and August. And this was the highest in 5 or 6 years. So the market is becoming more volatile. And look, it is some of it structural because there's a lot of passive index money that doesn't tend to trade on result day. And so you get these big swings because not a lot of the market trades. So there's that factor. But it's just also because the full disclosure, legislation. I mean, back in the day, you would often have a surprise on reporting season because the market's not been fully informed, but now it's fully informed, and so when it does miss it, it's like, wow, that's a complete and utter surprise. I'm going to sell that stock off or move that stock significantly higher. So yeah, it's been brutal. I mean, we felt that in our portfolios we dodged a lot of landmines. There's a lot of stocks that got blown up that we didn't own, but we still got shot in the leg, right? We still got our leg blown off for the ones we did. So it was really, really difficult to avoid any sort of blowups because they were from different sectors.
Yeah.
You had building materials, you had pharmaceuticals, you had all healthcare with the hospitals. So there was all sorts of industries that got caught up. And I think it's just how finely priced the market is, you get this volatility.
Yeah, absolutely. All right, let's move to housing. You say, what a mess.
Housing's an absolute mess, isn't it? So I've got a chart there on asking rents, which is horrifying for anyone who's renting. Asking rents in Australia were basically flat for 10 years.
Yeah.
We had a little bit of a dip in COVID where you could probably have a request to your landlord to cut your rent during COVID. But since then, we've just seen astronomical growth in asking rents for houses. That's going to flow through into higher inflation. So this is asking rent, so it takes a year or so to roll your rent over. But there's a housing shortage, and yet Building approvals out yesterday were down 8%. We're only building 190,000 houses. We probably need 250 to 300,000 houses. The government wants us to build 1 million houses, you know, so it's the rental vacancy rate in Australia is 1.5%. There are no houses. So we've got prices going up, rentals going up, and yet we can't afford to build houses, and we've got a lot of immigration. So it's a real problem. And I don't see an easy solution other than higher house prices, right?
And it's the NIMBYs too, right? You look at what's happening in Sydney's Woollahra, people just don't want more
No, you don't want your
apartments.
view built out. I mean, if you've paid all that money for a harbour view, you don't want a developer going up in front of you, do you?
Yeah.
So people are going to fight it.
Yeah.
People who have houses don't want more houses around them.
All right, Martin, always appreciate it. Thank you so much.
Thanks, Juliet.
Martin Crabb, Shaw and Partners. All right, back to equities. The stock of the day was Polynovo, and Andrew was joined by Michael Wayne from Medallion Financial and Sean Hickman from Market Matters.
We do have a pivotal clinical trial in the pipeline called BARDA. The FDA approval process is going to take a number of months really until that is known as to exactly what happens there. We've had a bit of a love-hate relationship with Polynovo. It does have a very good product, and the growth rates, as I mentioned, are very good. However, there has been a lot of upheaval, or if you like, at board level. It does have a fairly strong, some would say domineering chairman.
You're sitting there waiting for the FDA approval, or not, as the case may be, and we've seen some huge volatility over the last couple of months from stocks that have got adverse rulings accordingly.
Well, it always, with biotech, it so often comes down to these binary outcomes, doesn't it?
Exactly, and which makes it very, very hard to have it in a portfolio, certainly in any decent portion of a portfolio, because it's, as you say, it's a binary outcome. The stock's had a tough few years. I see no reason to buy it here. In fact, if anything, the gap up today would have probably been a bit of a sell for us, but right here, right now, the news is positive. I'd call it a hold.
All right, let's have a look at the market leaders on a day when we did finish in the red, and we mentioned Polynovo, they're up 9%, NRW Holdings too on that acquisition of Fredon. Clarity Pharma had a good day along with Tabcorp and Fletcher Building. The laggards in the session included Reece, down 4%, Bendigo and Adelaide Bank, which I believe was paying out its dividend though, down by about 4%. In the small end of town, these stocks had a great day, including Cettire getting a nice bid back after being hit hard in reporting season, up 19%. To the downside, we had weakness coming through from quite a lot of material players led by Lion Rock Minerals, which was down 12.5%. Tonight, we get US ISM Manufacturing Index for August, which is tipped to lift, and US construction spending for July. Tomorrow, of course, it's all about the June quarter GDP. We will also hear from Reserve Bank Governor Michelle Bullock, who's giving a speech. And a lot of companies going ex-div, so probably likely to weigh on the market again, including Newmont, Evolution Mining, Pro Medicus, Seek, and Whitehaven Coal. Let's have a look at where the market has finished the day's trade, down 1/3% there on the CBO 200. I think it's a similar loss on the ASX 200. Yes, 1/3%. But look, a very nice round number we've finished at, 8,900 points for those who love those technicals. We are, I guess, around 100 points off now from all-time records. But we'll do it all again tomorrow from 9:45. Enjoy your evening, and we'll see you then.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.